Bismillahirrahmanirrahim. Assalamu alaikum everyone, dear students. Hope you're fine. I'm back with the question and answer session of chapter 5. This has been done long ago, but I'm sorry for that I was busy with many other things and was not able to record a video to address your queries. However, I was addressing your queries on an ongoing basis through emails or text messages or audio messages on WhatsApp uh, on case-to-case basis. I addressed those queries that was possible to address through texts or audio messages, and for those or few remaining queries uh, on chapter 5, I'm going to record this video, and I hope this will be of help to all of you. Even after this, you have any questions, you are most welcome to ask. Now let's start with addressing the queries of students. So the one student asks, Assalamu alaikum sir, I have a question from end of lecture 26. Quick check solution. Why have you chosen first time is equal to 2 years and then it is for 7 years? For this we have to go through the statement and then solution. So the question is that Mindset Power and Light operates 14 coal-fired power plants in several states around the United States. The company recently settled a lawsuit by agreeing to pay $60 million in mitigation costs related to acid rain. The settlement includes $21 million to reduce emission from the barges and trucks in the Ohio River Valley, $24 million for projects to conserve energy and produce alternative energy, $3 million for Bay, $2 million for National Park, and $10 million to acquire ecologically sensitive land. The question of how to distribute the money over time has been posed. So a company has to pay this much in terms of litigation cost, and now they're planning how they should distribute payment of these amounts. So they are given with two plans, and they have to choose the one that suits them. Plan A involves spending $5 million now and the remaining $55 million equally over a 10-year period. That is 10 annuities of $5.5 million every year from year 1 to year 10. And Plan B requires expenditures of $5 million now at time 0 and $25 million 2 years from now and $30 million 7 years from now. Now here is the point that you asked. 5 million now mean at time 0. So for calculating its present worth, we do not need to make any calculation, and 25 million 2 years from now mean after 2 years. And when we calculate present worth, we have to calculate this amount at time 0. That's why from time 2 and between time 0, the difference is 2 years. So number of time periods will be 2, and we'll consider 2 years for converting 25 million in terms of present worth. And then 30 million is coming 7 years from now, means at the end of 6th year or beginning of 7th year. So for this, what we need to do, we need to consider 7 years for converting 30 million at present worth. And then we'll add all these three amounts to calculate present worth of plan B. Now the question is, we need to determine which plan is more economical on the basis of a present worth analysis over a 10-year period at an interest rate of 10% per year. Now let's start with plan A that involves 5 million at time 0 and $5.5 million each year from year 1 to 10. So this is an annual series of payments for 10 years, and we're calculating present worth. So we need to convert this annuity into present worth by using P over A factor. So P over A factor's value for 10% and 10 years will be 6.1446. And the present worth of option A or plan A will be 38.795300 millions. Now in terms of plan B, we have to pay 5 million upfront at time 0. So it will come as it is because it is at time 0 and this is present worth. Now 25 million after 2 years. So we have to convert this amount into a present amount by considering this 25,000 at the end of second year by considering it as present future amount. So P over F factor for 10% and 2 years will be used. Similarly, 30 million is a single payment or one-time payment at the end of 7th year. This is again a future amount, and we have to convert it in present amount by using P over F factor for 10% and 7 years. So P over F factor for 10% and 2 years is 0.8264, and P over F factor for 10% and 7 years is 0.5132. And the present worth of option B is 41.056 million. Now the criteria of selection in terms of uh, cost alternatives is less negative value and or less positive value. So by comparing both, we came to know that the present worth of A is less negative value. So the option A will be selected in that case. Is that clear for you? If not, please let me know. The queries reported by another student are, sir, in capital cost analysis, shouldn't we select the lower cost that is less positive and more negative? Or is it the opposite? So when we're talking about cost alternatives, what everyone wants to do, do you want to purchase a product at a lower price or at a higher price? Obviously, everyone would like to go for a lowest price or lowest bid if the quality is competitive in terms of two products, and we will select the lowest cost option. Similarly, in case of engineering economics or capitalized cost, same criteria will be applicable, less negative and less positive, because both are closer to the zero. And these are cost alternatives, means you are paying something. This is not revenue alternative. In terms of revenue alternative, or when we are gaining income, we'll try to gain maximum, and when it comes to expenses or paying dues, we'll try to pay less. So in case of cost, less negative or less positive, because both values will be closer to zero. So in simple words, we should select the less negative and less positive cost alternatives, because they are closer to zero as compared to other options, hence resulting in less cash outflows. Then the queries reported by third students are, sir, I would like to know the main difference between mutually exclusive alternatives and different type alternatives. So when we talk about mutually exclusive alternatives, these are kind of options or alternatives from those you can pick only one, and acceptance of one will lead to rejection of others. Means these are kind of events that cannot happen together. For example, can you sit and stand at the same time? No. You can be standing or sitting at one time. If you stand, you eliminate the possibility of sitting. If you sit, you eliminate the possibility of standing. So this is a mutually exclusive event. Similarly, flipping the coin, what will come, head or tail, both options or both possibilities cannot happen simultaneously. So this is again a mutually exclusive event or mutually exclusive alternative. Then you want to purchase a cell phone. There are several options, several cell phone companies available in the market, like brand Apple, Samsung, Sony, or any other brand. So you have to purchase only one phone. If you go with Apple, you will eliminate the possibility of buying Samsung and any other brand like Oppo or Q Mobile or any other company. So this is again a mutually exclusive event. Then let's take another example. If you have to come to university from your home, you have three different options, like you can use public transport, you can come at your bike, and your father is going to office, and he said, okay, come with me, I will drop you while going to office. So you have all these three options available, but the nature is mutually exclusive. If you go with if you go with one option, it will lead to elimination of other two options. Similar is the case in business environment. Let's say a company is about to purchase computers for their employees. They have two options, whether they can go for laptop or they can go for desktop. if they go with laptop, it will lead to elimination of the possibility of purchasing desktop computers. So such kind of events or projects are mutually exclusive projects. On the other hand side, the next thing that you want to know is what we mean by different life alternatives. So different life alternatives are those whose life is not equal. If we are comparing two options or two projects or two assets whose lives are different, let's say the life of option A is 6 year and life of option B is 12 year. In that case, such kind of projects are known as different life alternatives because their life is not same or equal. Next, what do we mean by present worth analysis must be made on equal service? What do we mean by equal service? So we can compare those projects whose life is equal, and this is known as equal service project. In simple words, that the projects must serve the organization or serve the purpose for the same amount of time, means their life should be equal. Then we can compare in terms of money, whether we should pay the same price or less price for which one. If the life of one option is 6 year, other option is 3 years, and there is difference in price, we can simply identify that if we have to pay higher price for the option whose life is high, this is justified on economic basis as well. So that's why we try to compare the options by using equal service assumptions, that everything else equal, and we decide project only on the basis of difference in their cost. Then the third one, can you explain how salvage value affect while making decision for certain alternative? Yes, salvage value will always affect the decision making process because we need to decide on the basis of present worth most of the times, and present worth is difference of present worth of inflows and present worth of outflows. And if we talk about salvage value, this is a cash inflow in terms of nature. And if we talk about the definition, this is the price, or this is the value or money that you can get after disposing of an asset once the asset has expired or its useful life has been passed. So this will give you some extra cash, and you can consider it while uh, measuring or calculating cash flows of a project. Obviously, this is relevant to decision making. Then, in simple words, this may affect by increasing or decreasing the level of net cash flows needed for the project. If the salvage value is less of one option than other option, so it will increase the amount of net cash flows required to purchase that asset. If this is higher, it will decrease the amount of net cash flows required to purchase that asset. Then lastly, sir, in LCM method, why do we minus salvage value from first cost? We have to minus salvage value from first cost every time, because to calculate net cash flows, we need to calculate net present worth, that is difference between inflows and outflows. And if we talk about initial cost, it is a cash outflow. On the other hand side, if we talk about salvage value, this is an inflow. So we need to take difference of both to calculate a final amount on the basis of which we have to decide whether we are going to purchase that machine or not. I hope you would answer my queries. Of course, I was supposed to answer your queries, but sorry for delay. Then the question number 4 is, Assalamu alaikum sir, hope you are doing great. Alhamdulillah, we are surviving this hard time as all of you. And I have a few questions from lecture 26 which I want to clarify. What is the difference between LCM and the specific study period? LCM method is a method that we use when the life of alternatives under consideration is different. For example, we have two options. Life of option A is 3 years and B is 6 years. Now we need to satisfy the equal service assumption or equal life assumption. So what we'll do, we'll calculate the LCM of life of both options. So in that case, 3 and 6, LCM will be 6. So we'll base our calculations for both options assuming that their life is 6 years. Then the specific study period. In specific study period, we are given a specific time period for which we need to make calculations. Mean number of time periods or number of years are fixed for which we need to compare the product. Whenever we are solving questions using LCM, it is always necessary to select the larger year as shown in the example. No, this is not necessary to select the larger year as base, but you need to calculate LCM, least common multiple of lives of the alternatives, and this would be considered as a starting point to calculate present worth, annual worth, or future worth of both alternatives for the sake of comparison. Then change in exact accurate. What does this term mean? So here is the proper term that we wrote in the slides. Cash flow estimates are the same for each life cycle. So cash flow means if the life is different and we need to repurchase an asset to satisfy the equal life assumption, cash flows will be the same for all each life cycles unless stated that inflation or deflation rate has changed. And the term means change in exact occurred with the inflation or deflation rate is that we have to change cash flows exactly in accordance with the rate of inflation or deflation if required. In case of inflation, we'll add the percentage increase in cash flows. And in case of deflation, we'll decrease the cash flows for next life cycle on the basis of deflation rate. Thank you. And I hope these answers are okay for you and you understand or I have cleared your queries. If not, feel free to ask. Now the final one is that, sir, can you please solve 2-3 questions regarding capitalized cost from book exercise? I am facing difficulty in question 31 and 32 of chapter 5. Of course, why not? Let's start with question 31. A wealthy businessman wants to start a permanent fund for supporting research directed towards sustainability. The donor plans to give equal amounts of money for each of the next 5 years, plus one now, so that 100,000 per year can be withdrawn each year forever beginning in year 6. If the fund earns at a rate of interest 8% per year, how much money must be donated? Now, this businessman is planning to donate 100,000 per year, starting at the beginning of 6th year from now. And he wants us to tell how much money he should invest at the rate of 8% per year, that at the start of 6th year, he is in a position to donate 100,000 every year to support this research. So for calculating capitalized cost, we need to use the formula that is A over I, means annuity divided by rate of interest. The formula is same, but the thing is that we need to understand this statement accurately. Here, this fund is going to start 6 years from now, not at time 0. And we need to calculate capitalized cost at time 0, but fund is about to start after 6 years. Because this businessman will deposit capitalized cost amount that will calculate in a fund that will earn 8% per year at time 0, but he will start donating at the beginning of 6 years. So let's draw the cash flow diagram. It will make it clear for you. So here is a cash flow diagram. we have number of time periods from 0 to 11. In first 5 years, we don't have any cash outflow because this funding is about to start at the beginning of 6th year or at the end of 5th year. So first amount of donation will come at the 6th year, then second one at 7th year, third one at 8th year, 9th year, 10th year, 11th year, and then this will be continued so on for rest of the life. And the amount is $100,000. Now first we need to calculate capitalized cost of this 100,000 by using 8% rate of interest. So this will be the annuity, in that case A value, and I will be 8% per year. If we calculate capitalized cost of this funding that is about to start from 6th year, it will give us capitalized cost at time 5. But the investor is going to start or planning to invest this amount at time 0, and the funding of project will start at the end of 6th year. So calculating capitalized cost at time 5 is not enough. So we need to get back this value at time 0. Basically, we are required to calculate capitalized cost of present worth at time 0. So then for moving back this capitalized cost calculated at time 5 to time 0, we need to consider this amount as a future amount by considering time 0 as present time, and we have to convert this amount or get this amount back at time 0 by using P over factor, because this will be a one time or single cash flow, and we'll use single payment factor, which is P over F factor. And here is the solution. Capitalized cost is equal to present worth, which is equal to A over I in that case. And for getting back this amount calculated at 5th year to time 0, we'll use P over F factor at 8% and 5 years. So 100,000 divided by 0.08 multiplied by P over F factor 8% 5 years, that is 0.6806, and the final capitalized cost that will be $850,750. So this businessman should invest $850,750 at time 0 at a rate of interest 8% per year to be in a position to donate $100,000 every year beginning from 6 years. I hope this is clear. If not, you are most welcome to discuss in person with me. Then the next question, question 32 is, Bob, a philanthropist, is not sure what rate of return his gifts may realize once donated to his favorite charity. We need to determine the capitalized cost of $10,000 every 5 years forever. So Bob is planning to donate $10,000 after 5 years forever. Means this cash flow, Bob will be donating 10,000 every 5 years forever, starting 5 years from now at an interest rate of 3% and 8% per year. Explain the significant difference between the two capitalized costs. Starting 5 years from now means, again, this will be a future amount, and this is consistently being paid forever after every 5 years. So this is a future amount, and the formula for calculating capitalized cost is A over I. And first we need to convert this future amount starting 5 years from now into an annual amount. So here 10,000 is a future amount, considering future amount, and we use annual amount to apply formula of capitalized cost. So we'll use A over F factor to convert future amount into annual amount for 3% and 5 years, divided by rate of interest 3%. And factor value is 0.18835, and the capitalized cost in case of option A will be $62,783. Similarly, in case of B, only number of sorry, number of years will be the same, but rate of interest will increase from 3% to 8 years. And factor value will change. For A over F 8%, 5 years, we have 0.17046. And the initial investment that is required to fund this charity is $21,308. Now the option C is to differentiate or highlight the difference in terms of capitalized cost. If we see when rate of interest is 3%, capitalized cost is 62,000 something. And when rate of interest increased to 8%, capitalized cost or investment to fund this charity is $21,308. From this, we can deduce that when rate of interest is less, more initial investment is needed to fund this charity at this rate of interest. Similarly, in simple terms, this is the answer of part C. When money earns at the lower 3% rate, it is necessary to start with more initial investment in terms of capitalized cost. That's all for the queries about chapter 5. I hope everyone is clear, and if anyone of you have any further question, please feel free to ask and I will try to address them in due course. Till then, stay safe. Allah Hafiz. We'll see you with next video.